stage so good. 5, 4, 3, 2, 1.
Good afternoon, everybody. My name is Mark Ingham. I'm a board member of the Investment Analyst Society, and it's a pleasure for me to extend a word of thanks to the team at Advanced Health for hosting us today on the occasion of their interim results. This is a very vigorous, dynamic company that's really shaping change in the healthcare landscape and sort of behavioral aspects that go with that. Carl, as we know, has great vision and has played a pivotal role in the industry over many, many years. And he continues to be at the forefront as CEO in driving this company to the extent that he has. If I recall back, Advanced Health listed, Carl, if I'm not mistaken, April 2014. So this marks 5 years of Advanced Health as a listed public company. It hasn't been an easy road, it's been a difficult road. But what we can see from these results is that the strategy that Carl put in place, and which is being co-driven by a great team of people, is really coming to the fore now. And more of those hospitals in South Africa are starting to be positive from a EBITDA point of view, and as they mature, so in turn will they contribute to the overall group profitability. The Aussie operations also doing very, very well for the group, and I think that example shows that in this market there's huge possibilities for this group. Bibi, as the COO, will take us through the operational side in this results presentation, and then Carl will follow up with the financial overview, and I'm sure they'll be very happy to ask questions from the audience. Thank you all so much.
Thank you, Mark. Advanced Health 2018, I'm giving you an operational overview of our 2018 financial year. It was characterized by significant changes in the healthcare industry. If you tuned into healthcare articles in the media, there's been a lot of changes with the HMI Competition Commissioner investigation, so we all know private healthcare is in trouble in South Africa. We made mistakes. Advanced Health admits that we made mistakes. Mark just said that we listed a few years ago and we thought we would be profitable much earlier than anticipated. So we admit that we made mistakes. But compared to previous years, this year we only added one additional hospital to our group, and that's the one in East Rand in Boksburg that we opened in February last year. And for the rest of the year, we're only opening Harbour Bay, which is in Simonstown, Cape Town, but only towards the fourth quarter of the 2019 financial year. If we look at the growth, and my comparison might differ to the financial comparison because I take a financial or I take an operational 2017 year compared to an operational 2018 year because of tariff increases in 2018, January. So our revenue and our case numbers have definitely increased by between 35 and 40% when compared to the 2017 operational year. And if you look at the specific disciplines, as we've said before, day surgery used to be dental surgeries, small, minor surgeries. Our focus has been on ophthalmology, orthopedic revenue that's increased by 20% when compared to the same time again. Endoscopic surgery increased by 30%. And then the lower revenue per patients, dentistry, ENT, and cosmetic surgery also increased between 5 and 10%. Just to correct myself, cosmetic surgery is not a low revenue. It is high volumes, but it's longer surgery with a higher income compared to dentistry and ENT surgery. The reality is that a change which took place around the world years ago is actually only becoming reality in South Africa now. 5 years ago, we had about 28 day hospitals. Today, we almost at 80 day hospitals, independent day hospitals, as well as the bigger groups that has obtained licenses as well, the Mediclinic group. So the enforcement of Discovery Health to channel day procedures to an appropriate same-day surgical facility has increased our theatre utilization. Unfortunately, we're only discussing numbers up to the December 2018. But if you look at our January, February, you can see the increases in our theatre capacity. So for those of you that do not know, Discovery developed a day surgery network where they said, a tonsillectomy belongs in a day hospital, so if a member wants a same-day surgery case, they'll have to attend to it in a day hospital. If they stay this in the acute hospital, the co-payment will be 5,000 Rand for that patient. That is not easy money that a big group will just write off. Years ago, the penalties were, and the co-payments were in the region of 2,000, 1,500. So to write that off wasn't that big an issue for the larger groups. Today, 5,000 Rand is a lot of money if you're spending 5,000 Rand a month on your medical aid premium. The specialists are remunerated at a much higher rate when they operate at a day hospital, and that's evidence also that a cost-effective care and the financial situation of a day hospital is cost-effective alternative to hospitalization. And then we all know whatever Discovery Health starts, because they are this big group in our industry, what they start, others follow. We've already seen Palmet following. The Palmet group has also secured day hospital networks groups. They've actually excluded the whole of Netcare on the Palmet business. So we can see the change that is taking place, and that is positive for us. Our challenges has been many, as we know, but it is exciting times that lies ahead. For the Discovery to have made this huge, and it's a bold move, to tell a surgeon to operate at a day hospital was a very bold move, and they're not pushing back. So healthcare providers cannot fight the system of smart hospitalization. We call ourselves smart because it's a smart hospitalization. We know what we do, and it's to the benefit of all in the South African healthcare. We encourage all the role players to rather work with us and not against us. You can just imagine when Discovery published the list of day hospital procedures and all the surgeons that pushed back. And we encourage the surgeons, come and look at our hospitals, come and see what we have, what we offer, why we offer this, and work with us. It doesn't help you to fight the system. The co-payments, penalties to patients when they're admitted to the acute care, as I said, the 5,000 Rand co-payments, that's also evidence of cost-effective surgery in the day hospitals. What are our opportunities in the market currently? There's an out-migration of day cases from the acute care, which is driven by the preferred provider network, the Discoveries, as I mentioned, the Palmets, as I mentioned. We currently have an underutilization of our theatre time. In all our facilities, there are spare capacities. Day surgery surgeons, because it's new for them, they prefer to have morning lists. Not all, most afternoon lists are still available. If we have 3 theatres, there's at least 1 theatre that's available in an afternoon list. So there's currently an underutilization, which we can definitely fill with a migration from the acute care. We're expanding our network of different surgeries as well. The marketing team has an intense effort to focus on specialists, and that's the next point, I think, to increase the theatre capacity. Increase further medical scheme support and medical funder networks as part of our opportunities, and theatre capacity due to the growing medical scheme networks. We're currently already doing Saturday lists, we're already doing evening lists, and evening lists means afternoon lists. Patients want convenience. A day hospital is convenient. If you have a grandchild, if you have a child, a small hospital setup, the small environment is definitely a convenient for a patient. It's a safe environment for a patient. What is our plan of action? Because that's what you want to know. Our financials are not looking that good, but what is our plan of action? And that's an intense marketing effort to retain and recruit quality operating specialists, but where the case mix is dominated by same-day surgery. It does not help us to sell shares to a cardiothoracic surgeon who cannot do his surgery at our day hospital. So we focus on operating specialists where the case mix is majority of day cases. We build loyalty with our surgeons. We build a relationship with them, and also with the referring doctors. We increase shareholding of the doctors working at the advanced health hospitals. Shareholding creates loyalty again. If I go through our PressMed presentation in Australia, most of the doctors working at a facility also has shares, and that creates loyalty to the company. We continue to appoint staff with the skill and experience required. The nursing staff are the core of our business. It's the core of any specialist attraction. If we don't have good nursing staff, there's no reason why a surgeon would admit his patients to our theatres. They admit their patients to our theatres because they've got confidence in the staff, and it's about the skill and the expertise of the nursing staff. We will continue to control costs and purchase the right product at the right price. And that is important. Standardization is difficult. It is a known thing in the big groups. We try and accommodate doctors, but our focus is to standardize costs and to create quality, effective care. I'm handing over to Carel Snyman, our CFO, for the financial presentation.
Thank you very much, Bibi. Good afternoon, ladies and gentlemen, and thank you for joining us again today. I'm going to walk through our financial overview. As Bibi said, we are happy with some of the figures that we've seen, and some of the other ones we hope that we would have had a better experience thus far. But let me take you through, and I'm happy to answer any questions that you may have after the presentation. If we look at our number of cases for South Africa and Australia respectively, you would see that our Australian cases has increased with 17% if we compare the first 6 months or the interim period of this year compared to last year. With that, our revenue increased with 13%. What I just need to add to that is in rand terms. And if you look at our Australian revenue per case, our revenue per case actually is stabilized at approximately 1,900 Aussie dollars. So that would be a bit skewed figures if we look at our Australian side of the business. Our number of cases for South Africa increased with 42%, and with that our revenue increased with 49%, which is indicating that we are getting the higher turnover cases, for example, our ophthalmic as well as our orthopedic number of cases are increasing. We are not just only looking at dentistry cases, for example, but we are getting the bigger cases into our facilities at this moment. For the group total, 29% for our number of cases, and then for our revenue, 22% for the group total. Our EBITDA, which is our earnings before interest, taxation, depreciation, amortization, Australia increased with more than 100%, South Africa was 7.2%, and then the group total once again 100%, more than 100%. Our profit after tax, we've used the word profit because Australia is making a profit at this moment, also increased with more than 100%. Unfortunately, South Africa decreased we increased our losses with 6%. And if we take out our new facility, East Rand, out of the equation, which has only been operational since February this year, 2018, I'm sorry, last year, 2018, the South African profits would have increased with 16%. This is unfortunately what we see every time that we open up a new hospital, that there is a period of actually losses occurring, and unfortunately that did bring the South African figures down a bit. Our cash generated from activities, we'll talk about that as soon as we get to the cash flow statement, and our cash generated also increased with more than 100%. Our exchange rate fluctuations, this is quite important as we have to convert our Australian dollars into South African rands, and if you can see, it's been up and down the past few years, but the past few months we've actually seen that we not that we can contain it, but actually it sort of stabilized the past few quarters. You can see sort of from quarter 4, 2018 up until quarter 2, the one that we are evaluating at this moment, 2019. Our number of cases per quarter, we can take you back of where the increases are, Australia and South Africa, and there is a definite upward trend of where we started off, and it's good competition between ourselves, Advanced Health South Africa in the red and Pressmed Australia in blue, and we are at this moment ahead in the race. What I just need to bring to your attention as well is if you look at quarter 2, it would increase, it would show a decrease every year due to the fact of the holiday seasons, which are impacting both our facilities in South Africa and Australia. Some of the facilities closed by the 15th of December due to the doctors taking leave at that period. And as we are not an acute facility, there's no reason for us to stay operational during those periods, and then we also close down. Our group statement of financial position. If you've been coming to our presentations for the past few years, you would see that the number of explanations of variances has started to decrease. The reason for that is that our balance sheet is starting to stabilize, if I can use that word. We have not opened up a number of facilities which actually distort the figures, and there are just 4 items which I would just like to bring to your attention. Our other financial assets, which has got a non-current asset area as well as a current asset area, increased to Epping Surgery Centre. It's one of our facilities in Australia, and they had to advance a loan to the Epping Property Unit Trust, and that is the reason for that increase over there. Our deferred taxes, as you will see if we get to the income statement, our deferred taxes have increased once again in South Africa due to the losses that we are seeing. And then very interesting, coupling with the lesser number of cases, if I take you back there, our cases are really not that many during the December holiday period. And we've managed to improve our debtor days, specifically in South Africa, from 17 days up until 7, as at the end of December of where we collected our cash to that extent. In South Africa, where we're profitable, in Australia, where we're profitable, there is an increase in the current tax receivable due to the income tax that had to be paid in Australia up front. Our second portion of the statement of financial position, our other liabilities, number 5, which also have a non-current as well as a current area, an increase of 24.3 million of where we received loans from one of our big shareholders, 24.3 million in South Africa and close to 600,000 Rand in Australia. And then our other financial institutions, we obtained loans in South Africa to the value of 4.4 million Rand. Number 6 are finance leases. There were no additional finance leases obtained, and an amount of close to 5 million Rand was repaid as part and parcel of our finance leases that we repaid. Our trade and other payables, also a decrease. That was one of our main reasons. Our CapEx expenditure also increased our trade and other payables, and we can see a definite decrease there due to the lesser capital expenditure that we are purchasing at this moment. Our group statement of profit and loss and other income, or as we know it as the layman's term, the income statement. Here I have 3 years comparative, December 16, December 17, and December 18. All of them a 6 months period. And our revenue increased from December 2017 to 16 with a percentage of 22%, and our cost of sales increased with 13%. If you compare the variance between December 2016 and 2017, our turnover increased with 33% and our cost of sales with 35%. We have managed to turn our cost of sales, our usage of cost of sales down, both in South Africa and Australia, a much better stock control than we had at that stage, and that you can also see that if your cost of sales continuously increase more than what your turnover increases, it's not very good business. But now we're in a position that our turnover is increasing with a higher percentage than what our cost of sales is. And that left us with a gross profit of 53% compared to the previous period of 49% and December 2016 of 50%, and that's an 8% increase in our gross profit. Our other operating expenditure, we're still seeing a high increase there, 17% versus the previous period, but it's coming down versus our 2016 figures of where it increased with 30%. Our finance cost, as we are still relying on a number of loans, has increased with 32%. Our rental paid, you will see that in the previous period we didn't have East Rand. East Rand came on about, and that was an increase of 20%. And our depreciation amortization is on a 7% increase, which is also indicating that we are not anymore purchasing or have such a big capital expenditure than we had in the past. The loss before taxation, there's a decrease of 32% of where in the previous period we had a loss of 31 million, and in the 6 months past we had 21 million, and last year it was 2016 versus 2017 it was basically on par. Our taxation is just a line item at the 30% of Australia and 28% of South Africa, bringing our loss after taxation also down with 32% compared to the previous period. The two lines are just showing how our losses are attributable to our owners of the parent as well as our non-controlling interest, and then our basic loss and our diluted loss per share, it is in cents, 6.21 cents versus 8.55. The two items are exactly the same, and then that's also a 27% increase versus the previous period under review. Our cash flow statement, I'm happy to say that for the first time that we are getting a positive cash generation through, sorry, it's not the first time, but we're getting a positive cash generated from our operations of 16.7 million, and then for the first time we actually have a positive cash flow at the end from our operating activities compared to a previous year of 14.2 million rands outflow, and in June 2018, which is our full year, we had a 13.1 million rand outflow. This is indicating that we are starting to generate cash from our operations, and that in the long term this would lead that we would be less reliant on actually having loans altogether. Our acquisition of property, plant and equipment, the full year 2018 we purchased 54 million rands worth of assets, 27 million in the 6 months for the ending December 2017, and then in this period we've acquired 13.4 million rands property, plant and equipment. Necessarily, it does not necessarily mean that if we have a facility operational that we do not require any additional capex. We might get a discipline that didn't work there before, that's, for example, need additional equipment. So our capital expenditure is not just limited with us opening up new facilities. It can also include additional equipment that is required if we get a new discipline working at a specific facility. This leads that our net cash outflow of our investing activities, 16 million outflow versus last year, the full year of 63 million. And we financed that with 76.7 million, close to 77 million cash from liabilities raised. You can see in that period we raised liabilities of close to 100 million. And this period of 6 months, the liabilities that we've raised is close to 31 million. So we only had to finance 20 million through our financing activities. Our cash increased, if you compare to the previous year, from 41 million to 49 million, and our increase is close to 9 million rands worth of cash that we've increased. There is not a big impact on our foreign exchange currency translation, as you saw on that graph that our Australian dollars versus South African rands are actually quite close to what we've budgeted for. Our statement of changes in equity, I'm not really going to spend a lot of time here. That was also on the SENS announcement. My pardon. Our key financial ratios, our quick ratio, there was a slight decrease. Our current assets less inventories divided by current liabilities, there was a slight decrease from 0.81 to 0.87. We're still happy with that figure. And our current ratio, our current assets versus our current liabilities, from 0.94 to just over 1. We're still also very happy with that figure. Our net debt less our cash to equity ratio, there was an increase from 38% to 69%, but we need to take into consideration when we do the calculation, is that it takes our assessed losses actually decreases our total equity. And there's just our segmental report. It's also fully, there's a more detailed segmental report on our SENS announcement, which I'm sure everybody had a look at. The turnover for Australia, close to 166 million converted into rands. South Africa, 78.3 million, giving us our group total of 244 million. Our profit, Australia generated a profit of 8.3 million. South Africa, unfortunately, a loss of 23.5 million. Also included in there is a significant loss that we had for East Rand due to the startup operations, and our corporate loss of 237, which is a cost center and does not actually bring in any turnover as such. And our percentage of revenue as a total, this is all converted into rands. South Africa is bringing at this moment 32%, and the total revenue for Australia is 68%. There's a definite change that South Africa is starting to contribute a high turnover number. In the previous presentation we had, it was 72% for Australia. Thank you. Are there any questions, or would we take questions afterwards? All right. Unfortunately, Mark Resnick can't be with us today. He had to fly back to Australia, and Bibi will also just handle the Australian, Pressmed Australian side of our business as well. Thank you.
Thank you, Carl. At our Pressmed Australia, we have 5 hospitals and a laser centre. We've got the Coffs Day Hospital. They're all in the eastern side of Australia. Coffs Hospital, Madison Day Surgery, Central Coast Surgery Centre, who also has a laser vision clinic, and we've got the Chatswood Hospital and the Epping Surgery Centre. Currently, Madison is the hospital that's got the fastest growth in our Pressmed hospital. As I said, 5 hospitals, a laser vision clinic, and there's over 130 accredited surgeons working at those 5 hospitals. We've done over 8,300 surgeries for the 6-month period, and there is a patient evaluation, like we do in South Africa as well, that patients complete, and there's a 93% patient satisfaction. Australia is also a member of the World Association of Eye Hospitals, which is one of the biggest ophthalmic associations. We are also part of the Royal Australian and New Zealand College of Ophthalmology, which is an accredited doctor program and a registered training program, meaning those doctors trained within our hospitals, our nursing staff are exposed to that, and it's the research and the training which improves the competency level. We are also affiliated to the University of Sydney as a teaching hospital, and once again, where skills are improved. For the consolidated group highlights for the 6 months ending December, there was an increase in patient numbers in our Australian counterparts of 17%. The revenue increased by 14%, same period last year. And the EBITDA also increased with 57%, and then the net profit before tax also increased with 105% for the same period the previous year. The milestones of the Pressmed group, the medicine surgery, as I said, is the fastest growing facility in that group, and it controls all the ophthalmology in that area. The Chatswood Medical Centre had to expand their pre- and post-operating operating space in order to cater for the staff, for the patient efficiency, because of the throughput and the efficiency levels. And the Central Coast Surgery Centre has every ophthalmologist in that region is working at that hospital. And the second part, which is important, every ophthalmic practice working there also has shares. And something that the South African industry learned from our Australian counterparts is, and we know that it just took a bit longer for South Africa, so our marketing team has got an intense effort to sell shares to our doctor, to our specialists in those facilities. That creates enormous, incredible loyalty. All these ophthalmic surgeons also work at other hospitals. They don't have a choice because that's where their referrers come from. But for example, if they do 5 surgeries at the other hospitals and 5 surgeries at our Pressmed hospital, we will engage with them and say, you've got shareholding with us, can you bring 3 of the 5 cases to us, totaling to 8 cases, and increase your cases because of the shareholding incentive that they have. The Pressmed group also had a brilliant initiative. They worked together with the referrers to bridge the gap and link the doctors and their referrers to our hospitals. This means they have this initiative. On a Sunday, they would invite 6 ophthalmologists, would invite their patients who have had surgery and the referring doctor or the optometrist to refer, and they will have a session and the doctor will explain this was wrong with the patients, this was the kind of eye surgery I performed on the patient, and this is the success factor. And the sharing and the liaison between the groups are excellent for support and for the referral networks. At Pressmed, we also host CPD events, just like we do in South Africa. We do that Sydney-wide, and we provide an opportunity for our surgeons to present then. And that's one of the largest ophthalmic conferences, well, where 28 ophthalmic surgeons would present and explain their research and engage with other surgeons. The doctors also perform charitable events at no-charge surgery. There is a big belief in our Australian counterpart at Pressmed to give back to the community, and this is exactly what they do. They reach out to third world countries. They would go to India, take our nursing staff, make a deal with a supplier to provide consumables, and our surgeons will then fly over, and they do up to 50 to 60 cataract surgeries per day on those patients, and that's by giving back to the community, which is a charitable no-charge surgery. They've also established a specialist advisory committee, also a Pressmed initiative, where the specialists would all contribute in a kitty, as well as all the hospitals. They would contribute to a kitty, and the specialist advisory committee would decide where that money goes for what purpose. Once again, interaction and doctors' relations is extremely important in both our industries. The focus for our Pressmed group is definitely on 3 things for the next year: driving up patient numbers, ensuring cost control objectives, and then also pursuing investment opportunities. The driving up patient numbers, something that is different in Australia compared to South Africa. In South Africa, it is a very territorial field. If an acute hospital not employs, if there's another surgeon coming on board, the other surgeons feel quite threatened that they could take business away. In Australia, it is absolutely welcome because they are so busy, their practices, so they welcome. They actually inform Pressmed, please, can you get an alternative ophthalmic surgeon because we need help. We need to expand our own surgery. They ensure cost control objectives are met. Management, with the support of the surgeons, are in the process of formulating standardization of surgical supply and lenses to reduce consumable cost. It is very difficult if you have 11 ophthalmic surgeons working at one hospital and they each have a preference of a lens or consumables. To standardize that is a huge job, and PressMed is working to ensure that that has happened, to control the cost and to bring down costs. There's a staff development program for our nursing staff to also improve clinical efficiencies. Obviously, when they link to the universities and the training hospitals, they also explore that opportunity to improve their efficiencies. PressMed is now looking at identify opportunities within the Australian Day Hospital Group to expand, and they are in constant communication with existing groups, independent groups. And my question to Mark was, why would someone want to join our PressMed group? And if you're a standalone business, it's difficult to be part of a network. It's difficult to negotiate. It is difficult to control costs. It's difficult to have bulk purchases. So an independent hospital will definitely join the PressMed group, the same in South Africa. And that's it from the PressMed group. We're taking questions from the floor now, and there's also questions from the YouTube. So we can see which one's first. Kudu, do you want to first start with a YouTube question?
Okay, so from the YouTube viewing, we've got 5 questions. The first question is, thank you and congratulations on improving the results. In terms of income and expenses, what would need to happen for Advanced Health to become profitable? What is the current number of patients treated versus the required break-even number?
We actually did that exercise very recently because we need to motivate our own staff, and we had to motivate the staff of what numbers are needed. We currently on about 1,800. If I look at the February figures through our group, we've admitted 1,800 and odd patients. For us to break even, we need to have a 2,259, so 2,259. However, this is based on an average revenue of 7,000 Rand. Some of our hospitals have a lesser revenue per patient, others would have a much higher revenue per patient.
Okay, the next question is, what are the increases in patient volumes being seen in January and February due to the Discovery Health day hospital policy?
It's difficult, and I wish we're excited to share that in June with the shareholders or with the investors. We can see an increase in each of our facilities. The numbers I don't have on hand currently.
Unfortunately, it's too early to say. We must also keep in mind that some of our facilities also only opened up during the middle of January, and then we also had some cases that were booked during the latter part of the year, and those cases were also Discovery subsequently made the announcement, and Discovery decided to allow those patients to go to the hospitals that they were originally referred to. So end of March would be a better indication for us as well, and then we would be able to share that information in our next year-end presentation.
The next question is, how underutilized are the theatres? What capacity are the theatres running at currently?
We are a theatre indent, so we don't work on bed occupancy. Currently, depending on the type of facility, but I would say in the group between 30, we have 30% we've had 42%, so in the range, I don't have the exact number, but between 32 and 42% is a good number. So the spare capacity to utilize a theatre 100% is even in an acute hospital, it depends on how many hours you've got available. So that's how we work. We've got, say, 8 hours available in a day, and then turnaround time is also needed. So you need a calculation for that. So our calculation is currently between 30 and 42%.
Okay, the next question is, when will you be doing a rights issue, and how much will be raised?
There's no rights issue on the cards at this moment.
The last question is, when will your next Australian investment be?
As I mentioned, we're currently looking at opportunities in Australia. When that will be, we're not sure. There are warm leads, and what we do in Australia, we don't build from scratch like we did in South Africa. We go to hospitals that are profitable already, independent, and need a bigger group. So, but when, I unfortunately can't say.
That's all from YouTube.
Thanks, Kuda.
If I look at the, don't know if this was part of the actual presentation, but it sends announcement, some very interesting figures here. If you look at the South African revenue in the 6 months compared to the 6 months last year, increased like something like 22%, whereas the loss for the period was up by 5%. Why are we achieving quite good growth in revenue and still finding the losses are increasing? Is that quite a lot to do with the opening of the hospital at East Rand?
Yeah.
So clearly, what it would seem is that the East Rand facility has taken quite a long time to start to produce something worthwhile.
Not really, Des, because if you think about it, it's only been opened now for a year. So it opened in February 2018. I'm still in 2018, so it's a year now. And then also what you need to take into consideration is that all of the facilities at the beginning actually, in fact, did that. So it's not specifically East Rand that we can point a finger to. It is at the beginning, and you must also take into consideration you have to have a certain number of nurses to run this facility. So most of our costs are actually, in fact, fixed. The rental is fixed. The nursing cost is fixed. The only two items that are actually variable is our cost of sales and then a small component of our nursing cost. And what we've also seen is that, it is bound to happen with our new facilities is that we start off quite well. It's going to take a dip, and then the rest of the facilities actually need to take up the slack at that.
Just to elaborate on that, the East Rand Hospital is our facility that's got the most endoscopy surgeries, scopes. Scopes are a lower revenue per case as well, but we've seen the influx on orthopedic surgeons and ENT surgery also coming in within the last few months, so it will definitely improve.
Just to labour that particular point again, the revenue in South Africa increased from 199 million to 244 million. The loss went up from 22 million to 23 million. Is it coming back maybe to the fact that we are still operating at the moment on a very relatively low occupancy per theatre? You talked about, I think, a figure of between 32 and 42%. What it's telling me is that if we were to move up to somewhere between 60 and 70%, the figures will change dramatically.
Definitely.
Correct.
And that's exactly what the Discovery Day Hospital Network has. I haven't looked at the figures yet or the occupancies, but definitely. That's why we support medical funder networks. That's why we on most of the network providers from the funders.
If we look at the last couple of years now, let's go back 3 years or so, what type of occupancy improvements have we seen in the theatres that we've got?
I would definitely say between 10 and 15% increase in theatre capacity, definitely. And theatre utilization, yeah.
So it is increasing.
Definitely, yeah.
Bibi, perhaps you could answer this question. Your growing footprint and your increasing acceptance as a healthcare service provider, not least shown by the leading healthcare funder backing you, is that eliciting a competitor response from the established listed hospital groups? And if so, would that possibly be a good thing, because it indicates that the market would be shifting and growing in your direction?
You're comparing it, I just didn't clearly hear your question. Are you asking whether the existing acute hospitals, whether we've had a competitive advantage because we...
And whether they are themselves moving into day...
Yes, yes.
In response.
In response, someone asked me that question a week ago, and for us, as such a small group, for a big group like Mediclinic, to have followed our example and actually obtained a few day hospital licenses themselves on a co-location basis is proof that we're doing the right thing. And Mediclinic is more dominant in Cape Town. I am myself from Cape Town. So it's a difficult competitive advantage there that they have, the Mediclinic group. However, 500 meters from one of our advanced day hospitals is a Mediclinic day hospital. And when I speak to the specialists, they say it is about your nursing staff. It's about the care you give here. The bigger groups might utilize their existing staff in the acute hospital environment. So whether it's totally independently run from the big hospital, we don't know. So we definitely feel that, but the competitive advantage is the staff, definitely. Okay, I think that concludes this, and we'll be available afterwards for some coffee and snacks if you're welcome. Thank you.
Thanks very much.
Thank you, Mark. Thank you, Mark.